So I think when I say the word markets, everybody, it's going to bring a smile to most of the faces in this room. We've had a tremendous year. In fact, we've had a tremendous decade almost in India. But what matters to us as investors is not the past, it is the future. And that is something that we're going to gaze a little bit into in today's panel. So if I could start, we've seen that primary markets have been buoyant for the past 12 to 18 months, but private markets, they've seen muted activity. So what do you think is driving this? I'd like to start with Bhavesh and then Subhrajit.
Thanks, Neil, and thanks, Mint, for having me here. I think we are seeing some tectonic shifts in the Indian capital markets right now in terms of fundraising activity. So far, IPOs were more like windows of opportunities, which would be like a 4 to 6 months or 8 months in a 3-year, 4-year scenario where you could actually do an IPO. And the rest of the time, there were maybe IPOs which are very sporadic. I think the private equity markets took advantage of that. And obviously, private equity markets grew from 2006 to about $50 billion of fundraising, which happened maybe a couple of years ago. But I think the idea was to always capitalize on the valuations which the companies wanted to kind of raise. But now with the advent of domestic capital markets coming in, and I think the reason why the IPO markets were a little sporadic was also the reason because FII money, I think the IPOs were largely dependent upon FII money, and that which was moody. But now with the advent of domestic capital flows coming in, I think the process of raising money is now becoming more continuous. And rather than windows of opportunity, we'll now see windows of patience to account for the volatility in the market. So I personally feel that I think this is a big change which is happening for the corporates to be able to raise money from the capital markets. Secondly, the valuations. I think the investors, obviously there is talks about froth in the market, but I must give a lot of credibility to folks in my panel here from the mutual fund industry. I think the amount of work they do to understand the company before they invest is at a different level compared to what we were seeing maybe 10 years ago. I think the processes have become very stronger. There's a lot of analysis, there's a lot of work which happens before they raise the hand that, yes, I want to invest money. So I think these are all significant processes and which they have been obviously because of the forward-looking understanding, they've been able to beat the private equity market. I think the private equity market will now have to roll up the sleeves. No longer are good companies going to be available at a throwaway bargain. And with the dry powder, which is now becoming very big, I think $60 billion is the dry powder that the Indian market has. The global dry powder in the private equity market is $4 trillion. And with the exits which are happening in the IPO market for the private equity, I think the returns are there, the fundraising is going to happen. They will have to readjust to valuations. They will have to readjust to looking at companies more from a promise than just a past track record, factor in both. And we're going to see a flurry of activity both in the capital markets as well as on the private equity side.
Just to add, I think on the private side, what we have seen, given the spate of also block trades that you have seen happening time and again over the past, call it almost 8 quarters, given a lot of confidence to private investors to deploy large amounts of money, knowing that there is a vibrant market out there to be able to monetize their stocks post-listing, which has also resulted in more buyout activities happening. Back in the day, any private equity investor coming into a buyout trade would only think about exit via a strategic sale or to another PE. but given how vibrant Indian markets have been and in a way been more resilient than what you have seen globally, the confidence for private equity investors to invest has gone up manifold, and also the formats, the flexibility with which they can look at transactions, you would find far more majority buyouts happening compared to, let's say, significant minority to minority stake sales that used to be typically the format that Indian markets have seen. Clearly is moving in that direction. So as you see public markets gain strength to strength, I frankly think on the IPO side, while we have seen a lot of activity over the past couple of years, and clearly India has been a standout market even globally, I think the next 2 years probably are also will also be watershed moments in terms of seeing larger transactions hitting the market, and we think will probably credentialize the Indian markets more meaningfully over the next couple of years, which in turn will give confidence of private equity investors to deploy more. Already seeing that trend, I think they only get stronger over the next couple of years.
Can you guys tell us a little bit about the IPO pipeline that's building up for 2024 and 2025, especially from digital first businesses? So Bhavesh first and then Subhrajit.
Yeah, I think the number of IPOs that we expect to happen overall this year, and I think there is a bit of factoring in the markets of the election results which has already happened in. But my sense is that once that really happens, it is going to set out a good flurry of activity. Last year the amount of money that was raised was somewhere in the vicinity of about 60,000 crores. I won't be surprised if the amount of money that will be raised in the IPO markets will be double this year. So that is one. I think as far as the new age digital companies is concerned, one of the major factors they will need to think about to tap the capital markets is going to be valuations and profitability. So I think a lot of the new age companies are clearly pivoting their model to profitable and growth. One of the major banes of the private equity or the new digital companies has been the valuations. We have seen valuations of companies which have a sales of 5,000 crores, a loss of 8,000 crores, being valued at $22 billion. It defies all corporate finance logic, and it is all effectively the cramming of the space all investors want to get in, the FOMO effect as we were talking about.
Which company is this?
Byju. That's an extreme example, Neil. Of course, it's a very extreme example. But I think there are a lot of unicorns whose valuations are, of course, unmatched to the kind of profitability. I think the public markets are very, very conscious about the profitability, about the growth, about the business modes. And I think if there is there's going to be a big difference in a lot of companies who are going to tap the capital markets. And if that is the kind of investment that they're looking for, they will definitely need to think about a readjustment in terms of valuation, reorientation in terms of valuations before they're able to even think about tapping the capital markets.
And I think over the next, to the point raised, over the next, this year and the next year, we'll probably see $15–20 billion of IPOs hitting markets. The good part has been the first cycle, roughly $7 billion raised last year. Most of the IPOs have traded well, priced reasonably well, which is why you have seen a very strong aftermarket. The aftermarket may have been varied and depending on technicals may have rallied very, very quickly, but at least at IPO the pricing have been quite reasonable. What is very important is as we get into this IPO calendar, which will build pretty much from quarter to quarter, IPO pricing will be very important, because if the first set of large IPOs get priced well, trade well in the aftermarket, probably sets the tone for the IPOs to follow, and probably kind of creates a nice 18-month calendar for large issues to happen. The good part is that we do see a very diverse set of IPOs coming across sectors, folks raising primary, doing secondary, and we just think it is a much better combination of themes than a certain particular narrative that we saw in the last IPO calendar in 21, which we think brings more balance and more stability to the markets. And also, as we have seen of late, after the 21 boom and the soft period in 2023, investors have also become mature to read each stock on its own. There is no mass euphoria or mass pessimism across stocks. Each stocks are kind of charting their own path depending on the performance and the merits or demerits of the case. And we hope that continues over the period. And to the point again raised, the rigor with which investors are also approaching the transactions by force also ensures that the pricing outcomes in the aftermarkets are generally pretty strong and pretty sustainable.
One more point I would want to add, since we're talking about valuations. I think IPO valuations are, considered to be an endorsement of all the hard work that the promoters have done in the last maybe 10, 15, 20 years in the journey of building up a company. And the higher the valuation, bigger is the endorsement and bigger is the chest that they want to kind of, bring out. I think that mindset needs to change significantly. I think IPO, in my view, is a start of a relationship, of a journey of value creation with a completely new set of investors, which are the public market investors. And I think, just having a very high priced issues and not performing or delivering on the performance which kind of builds in that number, is going to be a long-term value destroyer, in fact. So I think the mindset change needs to happen both in terms of promoters as well as on the private equity side. That this is a long-term journey of value creation. We have seen, and I'll let our fellow panelists on the buy side also kind of fill in on that. Typically, we have seen that in public market investors, they make their investments, but then they keep monitoring the company whether they're delivering to what they have done. And if they have delivered, they keep adding more and more. So we see a lot of significant P rating for companies who have been delivering. And that's where the value creation happens. So a short-term or a short-sightedness valuation at a time of IPO, can defeat the long-term value creation that can happen with the, with the new relationship that the company sets out in an IPO.
I want to now turn to an issue that's top of our mind to some of us because we made a ton of money from it, to the rest of us because our neighbors have made a ton of money from it, which is small and mid-cap space. So if I can start with Nilesh first. Nilesh, your views on small and mid-cap valuations and the signal that SEBI has given in this area with the stress tests, etc.
So Neil, there are good companies, there are bad companies. And there are expensive companies, there are cheap companies. Like until and Dharavi coexist in Mumbai, they coexist in stock market. As investor, your job is to buy good companies at reasonable price or sometimes at cheaper price. Today, on an average, if you look at SME exchange, the valuations are beyond our understanding. Maybe there are smarter people who knows how to value those companies, but we are not part of it. In small and mid-cap companies, again, there are some micro-cap companies where, in our opinion, prices have run up way ahead of fair value. But then there are people who are buying into it. Good luck to them. Broadly, market is optimistically priced. We have discounted up K bar 400 par. We have discounted Fed rate cut. We have discounted double-digit earnings growth. We have discounted solid fund flows from local and global investors. So with this optimism, market is fairly priced in large cap, probably in larger mid cap, little bit above fair value in small and smaller caps. But micro caps and SME, we believe prices are way ahead of fundamentals.
Especially the SME IPO index, right? When an index goes up 10 times in 1 year,
Yeah, there was Mohammad Azharuddin who scored 3 centuries at a trot. And then there was Donald Bradman, which scored 6 centuries at a trot, and both are world record. Now, SME Exchange has scored 100% return in last 5 years. I'm sure the way the momentum is, they will break the record of Donald Bradman. Let's see.
Vishal, any thoughts on this?
Difficult to add after Nilesh Bhai, but I think, one, I do think it is important to separate tactical short-term investment calls versus longer-term calls. So clearly, as investors, if you're coming in, looking at recent past performance, last couple of years, etc., then that is clearly setting an expectation which is most likely not going to be leaving you happy in some time. But as we also look at the macro environment, the structures, a lot of the other good things that my panelists spoke about, if you're going to miss out on those opportunities this decade, then that would also be a loss. Now, the market, like Nilesh Bhai said, provides opportunities. As fund managers, our job is to find those opportunities for the long-term investors. And in that view, I would think, given the type of supply that looks like coming, also the quality of supply that's been coming of late, because many of these companies, we have to keep in mind, are very different from the type of IPOs we were seeing 10, 15 years back. A lot of these are far better governed today. The expectations that promoters have are very different. The type of exits may be, from private equities who've pulled up the governance levels to a far different quality, first generation promoters, etc. So the quality that we are getting is also far better. And therefore, if you look at the opportunity in listed equity in this decade, and to say that I'm going to time it perfectly in small and mid caps and get in exactly when the time is right, I think that may be a bit risky. So if one is investing into India and investing into a lot of great work that's happening on the ground, this may still be a good way to participate.
Now let's turn to equity market activity from the government side, whether it is disinvestment or whether it is ETFs. I'd like to get Samarth and then Nilesh on this. What does the pipeline look like in the next, there's an election before us, but assuming that the most likely outcome does materialize, what does the pipeline look like?
So with respect to government activity, I think the nature of disinvestment has changed from it being need-based disinvestment to being strategic, i.e. the government doesn't need money because the revenue receipts of the government as a result of tax buoyancy, FDI flows, current account deficit being at its lows, means that the government is self-financing all the expenditure, and government is focused on ushering in good governance, accountability, growth in PSUs, which is why you've seen PSUs actually outperform over the last 12 to 18 months. That basically means that the government has strategic goals and financial goals, which is what disinvestment will get used for, and there is no rush, and which is why from the last 10 years you've seen a gradual change in the way disinvestment budget is calculated or put out. It is no longer a number they need to hit, but what are their objectives and which entities in these objectives they need to monetize. That's how it is tactical. And I think it reflects a government which thinks like a corporation and which is positive and refreshing for us as a country.
Let me give some counterpoints. When PSU market cap was 15 lakh crore and fiscal deficit was about 4%, government's divestment target was 65,000 crore. Now PSU market cap is 50 lakh crore. Fiscal deficit is 6%. Guess what is the divestment target? Should it be higher or lower? Higher. It's actually lower at 50,000 crore. Point number one. Point number two, how many of you have bank accounts in Indian Overseas Bank? Are you lazy or you don't have bank account? Or there's one person. I also have a bank account in IOB, so two of us. And how many of you have bank account in Axis Bank? A lot. Is there a reason why IOB should trade 2 times valuation of Axis Bank? Should the government be taking advantage and divesting? The answer is here. My advice to the government will be, today we have a great opportunity of China plus one. Countries like Mexico and Vietnam are outperforming us. Why are our manufacturing not as competitive? 2 things: one, power cost; second, logistics cost. Our industrial power is expensive because agriculture power is free, and industrial power carries the subsidy of agriculture power. Our logistics costs are higher than our peer group because, one, our composition of logistics, first water, then railway, then road, is actually reversed. We prefer road first, then railway, and then water. And more importantly, the commercial freight of railway bears the subsidy burden of passenger fares. The last railway minister who proposed increase in passenger fare was sacked by his own party. Thereafter, no one attempted it. Now, today we have a great opportunity. You have 50 lakh crore PSU market cap. Do a divestment instead of 50,000 crore of 1,50,000 crore, and use that money to absorb agriculture subsidies and passenger fare subsidies in the budget, rather than loading onto commercial power and commercial freight. Make Indian entrepreneurs competitive to the world. Grab China plus one opportunity.
Nilesh, I'll add to that. I know you have to leave us early, so I'll just add a supplementary to that. How does the ETF route compare to company by company divestment? Has ETF essentially gone out of fashion, or it's a good way of doing it?
So Neil, the best value you will get is by way of strategic divestment. The worst value you will get is probably by way of ETF divestment. And I'm glad government has taken the right step of moving away from ETF to strategic divestment and market divestment. In ETFs, if you remember earlier, the first ETF had 10% advantage if you remain invested for 1 year. Now, yes, you made that ETF success, but what was the cost? I think the divestment department run under Deepam has improved a lot. They are doing strategic divestments like Air India. They are doing market divestment in a far more reasonable manner, and which is where now we have an opportunity to take divestment to greater heights. Use divestment proceeds to make Indian manufacturing competitive and create much higher growth.
Now, can I turn to the M&A market and get Bhavesh and Subhrajit talk about that?
Sure, Neil. I think I'll talk about both P as well as M&A here. I think one of the major challenges with the private equity in India have been the exit. And what has happened with the spate of IPOs now that have been happening is that now the exits are happening. We saw almost 25,000 crores worth of money being taken out last year by private equity funds through the IPO. Add to that the block deals which are happening, around another 25,000 crores which is happening. So this is like a huge money being taken out in the market. There's clear anticipation that the public markets will continue to be buoyant and the block deal opportunities will be there. So certainly this has now changed the private equity mindset. India is in a bright spot globally. As I talked about, the 4 trillion dry powder out there in the world, and India having only $60 billion. We are going to see more and more capital being committed to India. We also heard Blackstone talk about $25 billion being invested in the next 5 years. So we are going to see a lot of activity, not only in terms of investments through private equity, but also in terms of control stakes taken by some of the private equity funds, and we talked about, we heard about from our previous speaker, that how professional companies have been delivering results more than promoter companies. So I think sentiment out, processes in, how that is in fact improving the efficiencies further. So we are going to see a lot more activity from the private equity side coming in. Pure M&A, which is a strategic. I think again, India is, we have seen a lot of Indian companies being acquisitive. We saw a chart yesterday where some of the big conglomerates are buying, doing 10 acquisitions, 20 acquisitions, obviously at a much good valuations and strategic fits into that. We've not seen a lot of inbound activity happening through M&A. My personal view is, I think India is on the clear radar of companies globally. They want to be entering India. And I think probably they're just waiting for the election mandate to be signed, sealed, delivered. There's an expectation that this will happen. But once that happens, we might see a floodgates of activity happening both on the M&A side, from the strategic as well as on the PE side.
Clearly, the activity we have been seeing on the M&A side has been a lot driven by sponsors, and I'll not add to the points made, but for obvious reasons, we have the confidence around the exits, probably also the fact that we have seen a change in the Indian promoter mindset to either partner or be commercial about their stakes in companies and not really being emotional about it, leading to probably more such transactions happening than what you've seen in the past. And we do see that trend naturally continuing, especially as sponsors manage to make good exits over a period of time in the markets. We have seen some softening on the strategic side, probably due to a couple of reasons. One is in their home markets, in general, most of these foreign buyers, potential foreign buyers have had a tepid environment, which doesn't really lend to making large, bold bets overseas. The valuation gap that India has vis-a-vis most of the global markets have only increased. It's always been there. Probably only increased in the recent past. It's not easy for a global player to kind of buy companies at multiples twice theirs in the environment that we are in. And finally, naturally, the rates have been all-time highs. Financing is a very important aspect in terms of as a trigger for global M&As to happen. And as the financing environment improves, the rates get to a more reasonable level globally over the next 12 to 18 months. We do see M&A also picking up with strategic buyers, while the PE buying activity and whether it be complete buyouts, majority stake sales, naturally keep continuing. India continues to enjoy a pride of place. We have seen India increasingly being part of global portfolios of PEs, not just Asia or India-specific funds. And as India becomes more relevant part of these global portfolios, naturally the ability to cut large ticket sizes increases, and we do think that gives again a lot of flexibility for sponsors to continue to make such M&As happen.
On a related note, let's talk about how India looks to global investors. Vishal, if we could start with you, particularly your views on GIFT City and what's happening there, and then Samarth.
So I think if we look at flows as one of the indicators, clearly, it's been a good start this year, but one can't say that it has been as strong as what we've seen in the past. And clearly domestic seemed to be a more stable form of flows so far this year. In aggregate, I would think that the strength of the rupee and in general the weakness of the dollar may be a large potential upside for all emerging markets and India as well in that sense. Because I think at least in the past we've seen high correlation between global investors looking at phases of dollar weakness as times to take a lot more emerging market exposure. That can be potentially an upside in terms of flows going forward. How much of that is fully baked into valuations, of course, up for debate. But I would be more positive, therefore, going forward. Also keeping in mind that interest rates generally, if one were to agree that are trending down, there are structural as well as cyclical factors which can therefore argue for a higher P to be supported, and therefore the argument that India is already expensive may not necessarily be true across the entire market. So I would be quite buoyant. Some elements of that we've seen is that whenever some sort of corrections start off, you see buying happening quite quickly, and therefore the corrections are not very, very deep, very sharp. At least the market, and I think my panelists will tell me that there's enough and more appetite, interest on the India story, the structural benefits that we are seeing, as well as the fact that there is capital available on the sidelines to deploy as and when one finds the opportunity. Our elections on their mind, I think, that could be one factor. But fundamentally, I would think that over the next 12 to 18 months, one can't rule out a lot more flows than what we've seen so far.
Vishal, on my second point on GIFT City, particularly for NRIs, anyone wanted to invest in India today has to fill up a dozen forms, open NRO, NRE, PIS, non-PIS. It becomes a pain. And in fact, a lot of AMCs don't even accept NRI money. Will GIFT City solve this problem?
So certainly a lot of interest seems to be coming through. And at some level, theoretically in the past, we would believe that NRIs can invest directly in rupee in Indian mutual funds, and therefore that's a great opportunity always available. But practically, like you mentioned, if you don't have an account, you have to open it. Two is, hedging the rupee is not something you're able to do that easily, closely, and the preference for dollar assets seems to be still, I think, prevalent. So I think experience seems to be suggesting that a simple process with a dollar product rather than a rupee product and a bit more steps in the KYC requirement or account opening requirement may be preferred, and that is certainly something GIFT City can solve for us. Early days yet, but we would be still quite optimistic about GIFT City allowing not just FPIs but also NRIs to come into dollar products.
Yeah, so talking about the foreign funds point, right? We, just as an example, post-COVID, lockdowns getting released in the global part of the world, the first market in Asia that a sovereign wealth fund, a pension fund, or a superannuation fund visited physically was India. And if you look at Indian infrastructure, you look at India real estate, the amount of institutional fund capital in that from sovereign funds, pension funds, superannuation funds, or private equity platforms or infra funds is probably the highest. That market is pretty much owned by the funds rather than by corporates. So India is already on the radar of all the global funds from a capital allocation perspective. I think the recent announcement by some private equity sovereign wealth fund said that they will deploy $10 billion in India this year. That tells you that the amount of capital coming into the country is only going up, it's not going down. I would say in a sense that India is the market which provides exits, as has been talked about. Last year we had probably $15 billion of blocks. This year already we've had $10 billion of secondary sell downs in one quarter. So in that sense, as you are able to exit better, you are able to invest better. And that is a virtuous cycle which India has, which if you look at it in Asia, the only other market which enjoys that right now is Japan, to an extent driven by corporate governance reforms in that market. So in the global context, we have US, Japan, India as three independent markets which are doing well. If macro in India continues to deliver for 12 months, India will no longer be an EM asset class, but it will be an asset class of its own, which foreigners will own directly, which they already do. But perception-wise, that perception of India being part of EM or Asia will gradually move away, primarily on account of growth, demographics, government policy reforms, which is why we are seeing India. When anyone talks of Asia, people are saying India and Japan. That's where I'm deploying money. And we are seeing that from actual on-ground activity, also by pronouncements. Just one more anecdotal example. The Korean sovereign fund opened an office in India. That is one of their only emerging market offices. RDI has opened an office in GIFT City. That is the only office outside Abu Dhabi that they've opened. So that tells you that we are relevant. Now, whether we become prominent is a function of our own macro, and it certainly seems like that our macro is going to make us prominent.
All right, we're almost out of time, just a minute and a half left. And thank you very much. It was a pleasure, and thank you very much to all my panelists as well.